So imagine you're watching a broader equity market crash, right? You're expecting everything to plummet.
Naturally, yeah.
But then you see one specific asset um, hit this concrete floor, dust itself off, and immediately climb back up. I mean,
Right.
that's exactly what Bitcoin just did.
Right, it's fascinating. We saw it drop to a localized floor of about $64,010.
Yeah, just kind of out of nowhere.
And then there was this purely mechanical recovery straight to $66,458.
Which really demonstrated price discovery completely independent of that broader market decline. So welcome to today's deep dive. For you listening today, our mission is to unpack the mechanics behind this broken gravity.
Exactly. We're looking at how traditional finance pipelines and artificial intelligence are just fundamentally rewiring both Bitcoin's market structure and its physical infrastructure.
And I mean, that price resilience isn't just an accident, is it?
No, not at all. It is the result of a massive structural absorption of supply by corporate treasuries. Like, the data points to a really clear structural decoupling. I mean, Bitcoin's annualized volatility has plummeted to a 30.4% rate.
Which is a staggering drop, especially when you consider the historical average sits way up at 81%.
Yeah, that 30% metric is basically the smoking gun. It shows entities are treating this as a primary reserve asset now, rather than just some speculative trade. Take Japan's Metaplanet, for instance.
Oh, right. They've been buying up supply.
Systematically accumulating 43,000 Bitcoin, actually. And over in Europe, you have Capital B literally shifting its core operational metric entirely to Bitcoin held per share.
Wow, really?
Yeah, they are applying traditional financial engineering to a decentralized commodity.
And the mechanism behind how they're doing this is just fascinating. It's like a game of corporate Pac-Man. Public companies are utilizing structured credit, so essentially issuing convertible senior notes to raise cheap capital.
Exactly, yeah.
Just to gobble up finite spot liquidity on the open market. They're leveraging legacy debt instruments to drain supply from an order book that runs 24/7.
Right. And to feed that immense corporate demand, legacy finance is rapidly constructing these massive regulated pipelines. Like, look at the European market expansion.
Yeah, the CoinShares news.
Exactly. CoinShares just launched a UCITS compliant ETF on the Deutsche Börse.
Which is a huge deal for that market.
It is, because UCITS is a highly restrictive regulatory framework. It has incredibly strict risk mandates. Before this, conservative sovereign pension funds were literally legally prohibited from holding unregulated bearer assets.
So the UCITS wrapper acts as this legal bridge.
Precisely. It unlocks billions in institutional capital, and, we're also seeing a surge in hybrid macro funds. The USCF Oil Plus Bitcoin Strategy Fund jumped 15.64%.
Because allocators are looking to hedge against energy shocks.
Right.
But I do have to push back on this structural paradox here. I mean, you're taking a decentralized, permissionless commodity and wrapping it inside highly regulated, centralized banking frameworks like UCITS.
I know, it sounds a bit counterintuitive.
Yeah, like doesn't that inherently defeat the asset's original purpose? You take a system built to bypass traditional banks and you just hand custody directly back to those same banks.
Well, the reality is that ideology simply does not scale to the trillions. I mean, a sovereign pension fund cannot manage private keys on a hardware wallet.
Right, they need the red tape.
Exactly. They require legal recourse, audited custody, and strict compliance structures just to participate. The market is basically favoring pragmatic integration over ideological purity.
Because that regulated wrapper is the only way massive institutional liquidity actually enters the space.
Spot on.
Okay, so while Wall Street integrates the asset on paper, the physical producers of the network, the miners, are executing a massive pivot of their own at the infrastructure layer.
Yeah, they're completely repurposing their physical operations for artificial intelligence. The economics of mining are just brutal right now.
How brutal.
Well, revenue has compressed to just $30.60 per petahash per day.
Ouch.
Yeah, and since petahash is just a measure of the raw computational power required to mine, the relentless network difficulty adjustments mean older hardware is now completely cash flow negative.
So they have to overhaul their business models.
Right. LM Funding America is literally renaming itself Power Computing.
Wow, just completely pivoting.
Completely. They're dedicating 26 megawatts to AI infrastructure instead of Bitcoin.
Which makes perfect sense when you look at the physical mechanics. It's like a traditional farmer suddenly realizing their land is vastly more profitable if they sell it to real estate developers for AI data centers rather than using it to grow crops.
That's a great analogy.
Because AI and Bitcoin mining both demand massive amounts of cheap energy and cooling.
Right. The opportunity cost is dictating the entire shift. I mean, operators like Riot Platforms are generating outsized yields, bringing in $32 million.
By mining.
No, simply by shutting down their rigs and selling their pre-purchase power back to the Texas grid during peak demand.
That is the ultimate irony. The most profitable thing a major miner can do right now is just act as a reverse power plant for the local energy grid.
Exactly. And, this convergence of physical energy infrastructure and traditional financial integration brings us to a really major regulatory catalyst.
A Clarity Act.
Right, the August deadline for the Clarity Act. This legislation aims to hand spot market jurisdiction over to the CFTC.
Which would regulate Bitcoin strictly as an agricultural or energy commodity.
Yeah, fully cementing it within the traditional federal oversight perimeter.
So for you listening today, this really means you need to reframe how you look at this space. The boundaries that once separated digital commodities, traditional banking compliance, and AI computing infrastructure have just officially dissolved.
Yeah, the integration is happening at both the financial and physical levels simultaneously. It's a completely new paradigm.
It really is. And I want to leave you with a critical question to ponder today as this ecosystem evolves.
It's a big one.
If the ultimate economic endgame for these massive mining operators is to simply abandon hashing so they can host AI data clusters, who will actually be left to secure the blockchain's physical infrastructure in the years to come?